the bottom line on inflation is that things are moving in the right direction, and we're seeing some of the hot spots really cool off nicely here as we move into the end of 2023. But I would be a little bit hesitant to completely sound the all clear. I still think that there's a bit of a road to be traveled here over the course of the next 12 months.
So we'll start and go ahead and put you on the hot seat. And why don't you talk a little bit about inflation and maybe views for the future?
Sure. So, speaking of the hot seat, I would say that the inflation seat has been cooling off here quite nicely, particularly in light of the numbers that we got for October earlier this week. And so, we think that a lot of the inflation that we saw during the pandemic, was in fact transitory. It was driven by things like supply chain disruptions. Then in 2022, to your point just now, you had the war in Ukraine, which pushed commodity prices higher. Certain parts of services have seen fairly significant inflation as well, but it does feel like we're coming down the other side of the mountain. Now, I'll say a couple of things on inflation. One is that the last mile of the inflation journey tends to be the most difficult. And so I have two little kids, and I kind of think about it in the context of a road trip, right? You set out and everybody's got their snacks and their iPad and things are going well. And then you get off that exit with 10 minutes to go, and the backseat is on fire. The last mile is always the most difficult. And I think that that's what we're going to see over the course of the next couple of months. We do think that inflation will get back down to somewhere between 2 and 2.5%. By the end of 2024. And we're really watching three things in particular to gauge that trajectory from where we are today to that point in time. We're watching what goes on with energy prices. We're watching what goes on with wages, and we're watching for any signs that a wage price spiral may be starting to emerge. Now, just quickly on energy prices, we talk a lot about inflation and what that means for monetary policy. The Fed and other central banks tend to target core inflation, which excludes food and energy prices. But the thing with energy prices is that if they go up and then they stay up, that begins to manifest itself in inflation more broadly across the economy. And so given the move that we've seen in inflation in energy prices as of late, we need to keep an eye on that for any signs that it's actually contributing to more broadly based inflation. The second thing, as I mentioned, that we're watching is what's going on with wages. The unemployment rate has remained relatively low as wage growth has decelerated here over the course of the past couple of quarters. But what I would say about wage growth is that it's right now between 4 and 4.5%, and that is inconsistent with the 2% inflation target over time. And so I think that the Fed does want to see a bit more cooling in the labor market and a bit of a further slowing, I would say, in wages before they really have that confidence that, again, a wage price spiral is not set to emerge. And to me, that's the elephant in the room. Because if you look at what happened in the 1970s, we found ourselves in this environment where higher wages led to higher prices, which then led to higher wages, which subsequently led to higher prices. And once that becomes ingrained in the economy, it can be very difficult to break. And so the bottom line on inflation is that things are moving in the right direction. And we're seeing some of the hot spots really cool off nicely here as we move into the end of 2023. But I would be a little bit hesitant to completely sound the all clear. I still think that there's a bit of a road to be traveled here over the course of the next 12 months.
Yeah, hey, David, on that road to be traveled. So if you mentioned that, if the goal still likely of the Fed is to get wages down and still slowing down and cooling off the economy, then wouldn't we expect a kind of a reverb into earnings and where that could really affect stock prices and overall market direction, as opposed to this? What's your views kind of on that and like this soft landing we keep hearing about?
So what I would say about the soft landing versus the hard landing question, and I'll move on to what that means for profits in just a minute. I really think it's 50-50. Some of the data we look at says, a soft landing does look like it's in the cards. Some of the data we look at says things are looking a little bit fragile in the current environment. Our base case view is that we are going to avoid a recession in 2024, right? We may end up with a recession in 2025, but the next 12 months for us, given the tightness in the labor market, look relatively okay. I don't think that we're going to maintain the pace of growth that we saw, say, in the third quarter, where the U.S. economy expanded by nearly 5% at an annual rate, but I also don't think that we're going to sail off the cliff tomorrow. I think you're going to see a deceleration in the pace of activity over the course of 2024, with those recession risks really building as we look ahead to 2025. Now, in terms of what that means for corporate profits, I think that that's really the key question for investors. And one of the things that a lot of people missed over the past, call it 18 or so months, is that if you're a consumer, inflation is like your worst enemy. If you're a business, inflation is like your best friend, right? It's just another word for pricing power. And so part of what has allowed profitability to continue to grow here over the course of 2023 has really been the fact that inflation is above its long run average. And so as inflation comes down, that will make the profit story more challenging. And it's really going to be up to what companies can do in terms of defending their margins, right? So managing their labor costs, managing their interest costs, managing their capital spending in an effort to maintain, some sort of decent run rate of profitability. But we do recognize that consensus estimates for 12% earnings growth in 2024 are probably a little bit too high, given our outlook for the economy at this juncture.